Welcome to the Investing Mastermind Podcast. I'm Signe Lundholt.
And I'm Michelle Markey.
Today we're featuring an interview with Wesley Chambers, an investor and content creator from London, England. You might know him from Instagram, where he's known as Investing with Wes. On his Instagram, he shares company case studies using Warren Buffett's investing strategy, and that's how I got to know Wes.
And I think it's going to be a special treat for our listeners to learn from someone who is so well-grounded in the Warren Buffett style of investing. So we hope you enjoyed the interview with Wes.
We'd like to start out by having you talk a bit about how you got into investing and what drew you to your current investing strategy of investing like Warren Buffett and Charlie Munger.
Okay, so I first started investing in March 2020. So that was during, the whole chaos of the market just crashing. During that time, I think I got into some companies like Carnival Cruise Line. I got into some travel companies, and yeah, that was the time when everyone was bailing. So I got into those. I made some decent return once everything recovers. I also started getting into some really speculative investments as well. So I got into things like gene editing, like CRISPR. I got into some EV stuff. I got into some green energy stuff as well. And I thought I was doing the right thing, So I made some decent returns on that, but something just hit me over the head where I said, how am I making this crazy amount of gains within a short time? Like, is this normal? Is it not? So I started like questioning that, and I just started going online, and then I discovered Warren Buffett and I discovered value investing. So that pushed me to learn more. I just started searching up random videos about value investing, came across a YouTube channel, and when they were doing fundamental analysis, that was just something new to me because I never used to look at the balance sheet, the income sheet, the cash flow sheet. I just thought, okay, this company might be the future. I'm just going to buy it and hope for the best. That was my thesis basically. And so when they were doing all this fundamental analysis, looking at how much the company makes, I was like, this opened a whole new world to me. I was amazed, and ever since then, I just started learning everything I could about value investing, and I sold everything, sold all my old portfolio that filled with speculative investments, travel companies, all these companies that crash, and I full on went to value investing, and I bought my first quote value stock. I bought Sprouts Farmers Market. I also bought Academy in Sports, and ever since then it's been an amazing ride, to be honest. I'm having fun. I'm meeting a lot of good people, and yeah, I sleep I sleep good at night knowing I don't have to worry about my portfolio. It's a more stressful thing because if I held on to those company, I'd probably be deep underwater right now. Like with the companies I used to hold. Like I'm just listing you the basic companies I hold. I used to hold a lot more crazy, like Jumia. I'm not sure if you heard of that one. So Jumia is like the Amazon of Africa. So I bought that $6 a share. I sold it, I think, around $50. So yeah, it was a stock recommendation by my cousin. So I sold that at $50. I had quite a lot in that. And if you look at it today, the stock is probably at around $3. So if I didn't sell it, I would have been so deep underwater. I've had a lot of really bad speculative investment, but now I've got a solid foundation where I could look at the facts. It's not based on hopes and dreams, just based on facts, really. So I'm pretty happy.
Well, that's great. And when you said you were initially investing a lot during that March 2020 crash, and then somewhere along the way, at some point, you discovered more of, say, Warren Buffett through YouTube videos, and it seems remarkable that you discovered that so quickly. And when exactly did you come across like Warren Buffett or that like fundamental analysis?
So I would say 1 year after. So yes, to 2021, I would say I discovered it all. And that's when I just changed everything, and just switched to a more sound approach to investing, slow and steady approach. Like the fast money does not work, and that's proven. If you look at the current, environment with all these, really speculative companies that don't make a profit or cash flow, they've gone up so quickly, but they've come back crashing down so quickly. So I think if you want to compound over time, that's not the right way to do it. It's all about the slow approach, and just get that slow compounding going and focus on not losing money.
Yeah, I think it's, thank you so much for sharing, Wes. I think it's a quite remarkable story, because most people, if they had that kind of return, they would stick
Mm-hmm.
to what they were doing,
Mm-hmm.
and just continue to speculate in the
Mm-hmm.
stock market. Was it a YouTube, or what exactly were you pursuing a strategy, or what exactly was it that drove you to sort of change the way you were doing things?
Mm-hmm. So when I was speculating, I made around 53% in 1 year. So I don't know what clicked with me. I think I just stumbled across something, and then I was learning about P ratios. I was learning about, profits and all that stuff. And when I stumbled, like I was looking at P ratios, they say, if it's a low P ratio, it might be cheap, but it's not always the case. But it's a general indicator, just to see how companies, valued. Then I started going on stock screeners, looking at the lowest P ratio stocks, and that's where I found Sprouts. And then I just went on YouTube, typed in Sprouts to see what others are saying, like, and that's when I learned about how to look at a balance sheet, the income sheet, and then I started digging deep into Sprouts, and yeah, and then ever since then, I just started applying that, slowly building out my process over time. At first, my process wasn't like, really good. There's a lot of mistakes that I made at the beginning, but once, you fully learn value investing, you learn, the pros and cons and stuff, you have a solid foundation going out. And I feel I'm at that point now, but I'm still learning.
Yeah, absolutely. And, we have a lot of listeners with us, and a lot of them don't come from within the financial industry. Is that where you come from? Or tell people a little bit about, you know,
So no, I've got no background in finance, and to be honest, I'm not really that good at maths as well. So this whole, value investing, it's a lot of numbers, but you just have to, it's just something that just clicked with me, like the numbers and all that stuff. So I've got no financial background, or no one in my family that really works in the financial industry. So yeah,
that's
it
really,
just
really
resonated with
cool.
me.
Yeah.
Yeah.
Yeah. I definitely, even though there's a lot of math, it seems to be, really, we're really guided by common sense most of the time in value investing, is my experience, right? With the
Yeah.
numbers and things like that. All right. So what would be also great to know is some of the resources that you have used to inform your investment style,
Mm.
which resources you found useful on your journey. Maybe you want to share someone you follow, or some books or resources like that.
So when I first started, I mostly consumed a lot of YouTube videos. So I watch a lot of finance YouTube channel. I watch Everything Money. I watch Monish Pabrai's stuff as well. I watch a lot of, uploaded videos by Howard Marks, Seth Klarman, Warren Buffett, Charlie Munger. I just consume each one at a time. So first start with Howard Marks, for example. I find that he helps with the psychology, so that's helped me a lot with my psychology. Then Warren Buffett has helped me a lot as well. Seth Klarman has helped me a lot. So yeah, those kind of people. But you have to be very careful with social media in general, because there's a lot of really bad financial, education out there. So it's about, finding those needle in the haystack YouTube channel that will help you to learn. And I'm enjoying that. But as for books, which is I've got into recently, I've read Intelligent Investor, Mastering the Market Cycle. I've read Margin of Safety, and I've read Richer, Wiser, Happier. And also, there was a book, You Can Be Stock Market Genius. Those are the kind of books I've read. So, yeah, those are resources I've been gravitating towards within the last year and a bit.
And what stands out to you about, say, Margin of Safety by Seth Klarman?
I don't know. I feel like I resonate with Seth a lot. I like his approach. I watched a lot of videos. It's very rare to find him publicly speaking. So yeah, just like it's a no nonsense really with Seth Klarman. He just says it how it is, and I've enjoyed looking into him from the short period of time. But Seth, the Margin of Safety just breaks everything down that I've been learning, and it shows what I've not been learning is not nonsense. Like Seth Klarman says it, Warren Buffett says it. They all say the same thing. So yeah, and they've all had these crazy returns over a really long period of time. So yeah, that's it really.
We were wondering also where your strategy, you just spoke a little bit about it, but where your strategy falls within this Buffett spectrum. There's actually a lot of disciplines within the Buffett style investing spectrum. Do you take a very different approach than Buffett, or do you blend other strategies? Where on the spectrum do you fall, do you think?
So my strategy is mainly like a early days Warren Buffett / early days Joel Greenblatt. So Warren Buffett, he mainly focuses on a lot of these smaller companies, and Joel Greenblatt focuses on special situation. So for me, I've just used those two approach as I feel, for the average retail investor, we haven't got large sums of money to move around. So finding all these small companies can help us, to compound really well over time. And also these small companies, like it can give you really good outsized returns compared to the market. And I feel for me, as an average retail investor, I feel that's like a good approach to take because these companies are often not on the radars of big institutional or money managers or all these stuff. And sometimes they're not in the index fund. So I find great pleasure just finding these little obscure companies, studying them and just wait for the market to appreciate them. And that's just mainly my strategy, really, just to focus on small companies and also special situation. In terms of special situation, I like spin-offs. They're my favorite thing to look at.
You have an Instagram channel, Investing with Wes, where the audience can follow you, and we really enjoy your content on Instagram, as well as the newsletters you send out with your business cases, and you use a checklist. Can you share more about your checklist approach with the listeners?
Okay, so the checklist approach, right? So it's more like it gets me asking questions, really. So it gets me thinking. The checklist. So the first thing I like to look at is the 5-year average PE ratio. I like that to be less than 15. And then I like to look at the 5-year average return on invested capital. I like that to be at least 10% and above. And then the 5-year average profit margin, 10% and above. And then revenue growth, I like to see a little steady increase, something that's really predictable. And that's the same with net income. That's my other one. I like steady increase where it's predictable. I like the shares outstanding to at least stay the same or decreasing. I like so this one measures debt. So I like to look at the current debt to equity ratio. I like that below 1.0. Free cash flow, I like to see a steady increase in where it's predictable. 5-year price to free cash flow ratio. So I like that to be below 15, which is in line with the PE ratio. And then the current free cash flow yield, I like that to be about over 10%. But the idea of this really, the checklist, is to get me asking questions and to interpret it in a way where it's in line with the current company. For example, if I'm looking at a tech company, right, and they've got, let's say, 10% profit margin, that's a red flag to me because, tech companies, they tend to have really high margin. But if I'm looking like a retail and they have a 10%, profit margin, that's really, really good. So the idea is to just put things into context and get me asking questions during my research phase. But yeah, that's the idea of the checklist. I think a checklist is really important if you're an individual investor. It saves you investing in terrible companies, and you'll be surprised a lot of people don't have it in this market. And
Mhm.
it's saved me a lot since I've adapted this checklist. I've avoided a lot of terrible companies, and yeah, I encourage everyone to have a checklist.
That's awesome. And how do you find a wonderful business that will be able to fit into this checklist? Because I'm guessing that
Mhm.
you might need to look at different resources. Like, do you use any screeners to initially look for potential candidates that you then measure against your checklist?
Yeah, so I'll say my current portfolio right now is all from screeners like that I found. I think one thing about me is I'm really good at finding these gems in these screeners. So the screeners that I use three because I like to see what different screeners offers. Not all screeners offers the same companies when you put in these criteria. So the first screener I use is FinViz. I use that. I also use Yahoo Finance Screener and also Simply Wall Street Screener. I use those three when I'm doing the screening sessions and see what I could find.
Finwiz is my favorite too.
Yeah, it's a really good one. It was the first one I discovered, to be honest.
And when you're evaluating these companies, do you feel like you need to have some kind of connection or meaning to any of them? Like, say a wonderful business sometimes can be something that we personally care about. Like, for example, I worked at Starbucks as a teenager. So to me, Starbucks has meaning. But do you feel like it's necessary to have that? Or, even if you may not have ever shopped there or been a consumer of some companies, um, just wondering, how do you decide or feel like you find meaning in some of the wonderful companies you come across?
So the companies, if you look at my current portfolio, um, I've not used any of these companies' products. I've known about the products, but I've not used them. So, for example, I hold Alibaba. I know about the products, like what they do, but it's not something I haven't really shopped on there, but I just know about it. But for me, how I form this connection with this company where I can wrap my head, it's just all about circle of competence, really. Um, I tend to invest in a lot of, tech and retail companies, so could be retail of any sorts. So that's how I find, an understanding and connection with these companies. I feel more comfortable investing that way. So yeah. And also another thing I like to know, with these companies, say everyone knows about the brand and the product and they've used it, it's very hard to find a mispricing because everyone knows about them. So I tend to prefer companies that no one knows about and they're just obscure.
And what type of things do you look for in a company to assess if they have a durable competitive advantage or a moat,
Uh,
as Warren Buffett likes to call it?
okay, so first I like to look at the return on invested capital to see what it's like, what returns they get in on the investments. That's why I have that hurdle rate of 10%. I also like to look at the management, see what their track record have been like over a long period of time. And also their capital, I like to look at different stuff as well, like capital allocations, all these different stuff. And also I like to look at, how the business have performed over a long period of time. I have this rule where I try not to invest in companies that are too new. So the IPO like 5 months ago. I like to see a good track record of the business to see how it's coped with certain, environment. And that's how I go about it. Because I like to see a predictable thing.
And what are some of the criteria you use to judge management's performance?
So management performance, as I said, I like to look at the capital allocation. So are they buying back shares at the right time or paying a dividend or something, or are they reinvesting into good, acquisitions? Those kind of things I like to look at really. And also the management to see what their track record, their CV has been like over their career to see if they've got, skin in the game.
Yeah, absolutely. That's so important. Buffett, he talks about owner's earnings when
Yeah.
he evaluates the intrinsic value of a business. Which valuations methods do you use? And can you explain your approach there?
So I just use a simple DCF model.
Discounted cash flow, DCF.
Thanks. So I just use a discount cash flow model. It's not really a complicated one, just a simple one, project out the growth of the company, also have the exit multiple, also what the current free cash flow is, what the debt is, what the cash is. That's about it really. Just a simple one, just to get a value of what I want to pay for a company. I feel if you're looking at the companies, it's important to pay an appropriate price for it, because obviously the lower you pay, the better your return, and the higher you pay, the worse your return. And I feel it's important to have a good margin of safety, because you don't know what's going to happen tomorrow, 5 years down the line. So
Right.
yeah.
Sorry, how do you arrive at multiples? How do you determine those of like what's a fair multiple to a company, and how do you determine the exit multiple?
For example, I like to look at what it's historically traded at. So, for example, if a company is historically traded at 20 times earnings, I like to pay between 15 and 16, just the market average. There are some companies that historically trade at, I don't know, 12 times earnings. So I have a rule where I have a rule where I'll pay between 8 and 10 times, that's the kind of rule. But obviously, the cheaper the multiple, the better. That's the way I go about it. I don't like to pay over 17, 16 times earning. 15 is where I just keep it nice and conservative. But a lot of people have said I'm really conservative, and I don't know, that could be a good or bad thing, who knows? But I'm fine just sticking with this approach.
Yeah. Do you ever worry about like if something were to be a value trap because it seems so attractive on a low PE or other metrics, and then other people never recognize the value of the company, and then it just goes sideways, or it might go a little bit but not like up into the moon? So maybe like like those are maybe sometimes value trap situations.
You have to be very careful, obviously, with value traps. So I don't invest in companies with low PE and they've got like stagnant growth. That's too scary to me. And there's one that comes to mind. Someone asked me about it, like Walgreens or something. Like I don't know if it's a value trap or not. It's low PE, stagnant growth. I don't know if it is a value trap. So I just stay away from it because I'm not too sure on that one.
It makes me think of a question: what would actually make you sell a business? Once it's in your portfolio.
Okay, so I have a few criteria in terms of selling. So one is if my thesis has changed, I would happily sell it. I have no reason to own a stock if I don't believe the current strategy of the company. Also, if the company is at a really bubbly valuation where it's just too expensive, so I tend to sell. Also, if I find a better investment where I could get a better return elsewhere, that's another thing that in terms of what can cause me to rebalance things.
All right. So Buffett says that the three most important words in investing is margin of safety. What do you consider to be a sufficient margin of safety?
So when I'm doing my analysis, I like to use a 15% discount rate. So that acts as my margin of safety, as well as when you put in your assumptions that will affect the margin of safety. I think 15% return for me is good enough. It means, if I'm wrong, that would probably go down to what, 13%, 14%, whatever it is. But I think 15% should be good enough for anyone at my stage. I think 10% is too low. So I think 15 is good.
We hope you enjoyed this episode. If you want to know more about Wes, you can follow him on Instagram. Search for Investing with Wes. He also has a Twitter account and a great newsletter that we will link to in the show notes. See you on Tuesday. If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.